And some very good employees, some very good bankers, conspired to become bankrupt. I would say there absolutely are systemic risks in the banking business. Systemic risks brought about by bad behavior among consumers, among bankers, and politicians. If you examine, as an example, the collapse of Silicon Valley Bank, you see an improbable circumstance where a very good franchise and some very good employees, some very good bankers, conspired to become bankrupt. Let's examine how they accomplished that really very improbable task. In the first instance, and I think many people know this now, there was a mismatch in terms of duration between their assets and their liabilities, which is to say they were borrowing short in overnight deposits, now deposits and demand deposits, to lend long. They were chasing yields, 4, 5, and 6-year yields, when the interest rate differential between the longer bonds that they were buying and short-term instruments was tight enough that they shouldn't have been taking the risk, which is to say they took a lot of risk for not very much reward. They did it, too, borrowing short to lend long, against a deposit base that was unusually suspect. Most of their depositors weren't Ma's and Pa's. They weren't federally insured sticky deposits. They were, in fact, wholesale deposits that were introduced to them from two sources: venture capital funds and technology companies. And there was two impacts around that, which is to say a fairly small flight of depositors could have an outsized impact on the bank because of the size of the depositors, but also because they were unusually dependent on the technology industry. Venture capital firms would deposit money on the bank that they had raised from investors before they deployed that capital in investments. And the companies that they invested in, the technology companies, would deposit equity before that money had been spent on operations. Two things went wrong for Silicon Valley Bank that were related to each other. The tech slowdown meant that fewer new dollars got raised by the venture capital funds and deposited in the bank, at the same time that the deposits ran off as those funds invested the money. Similarly, the companies that they invested in for the last 2 years have had a very much more difficult fundraising environment, which meant that new funds weren't coming into the companies at the same time that the funds were being run off. So Silicon Valley Bank experienced a deterioration in their liquidity, their deposit portfolio, at the same time that rising interest rates changed to the negative the value of the assets that they held in the bank. A truly ugly circumstance, one that could have been avoided by prudent banking. One needs to note, however, that prudent banking wouldn't have allowed the bank to grow as fast as the bank grew. And I suspect that's the last problem. Silicon Valley Bank, like many banks in the country, like many of us, has lived through an epoch of 40 years, beginning in 1982 and going to 2022, that were probably the most benign economic climate in human existence. The demographic boom from the baby boomers coming of age, working, saving, investing, globalization, but particularly lower interest rates. Lower interest rates lowered the cost of capital, they stimulated consumption, and of course, people were allowed, in effect, to write assets up every year as the capitalized value of rents and distributions increased. Wonderful set of circumstances. But that game changed in 2022. And I'm afraid that consumers, politicians, and bankers, particularly go-go bankers, didn't adjust with the times. The result was, I think, fairly obvious. You know, too many investors and depositors look at the top line number on a headline. They say 7% is better than 3%. Well, it is if the probability of getting the 7% back is as good as the probability of getting the 3% back. Unfortunately, believing that that's true is the same thing as believing in Santa Claus and the Tooth Fairy. You know, it doesn't work. It absolutely, positively doesn't work. Many depositors today don't know anything about a bank's statement of financial condition. The FDIC requires banks, if you request, to ask for a statement of financial condition. You should ask how much equity the bank has relative to total assets. You should ask about the mismatch between deposit duration and asset duration. And you should ask, too, about the amount of cash on hand relative to the amount of short-term deposits. Those are three critical elements in the financial health of the bank that you've deposited your money in. And I suspect that not 1% of America's depositors know what an FDIC statement of financial condition is. It's very simple. It isn't kind of simple, it's very simple. You just have to do it. The FDIC, in their wisdom, yes, I'm being sarcastic, has suggested that a 7% equity slice is necessary for a well-capitalized bank, which is to say that 7% of total assets should be equity. For some reason, I prefer 10. I prefer 20. But the truth is, what the FDIC is saying is that it's okay for you to be an unsecured creditor, that's what a depositor is, to a regulated hedge fund that's leveraged 9-to-1 with a time mismatch. The FDIC might think that's okay, but it's your money, not the FDIC's. So look at the percentage of total capital represented by equity in your bank. This is contained in the Statement of Financial Condition. Look, too, it's not very difficult. Look, too, at duration mismatch. And look now, because there's lots of websites that talk about it, about the mark-to-market delta between the book value of the bank's assets and the market value of banks' assets. Many banks have lent long, and in a rising interest rate environment, the bonds that they bought were worth less than they bought them. The regulators allow banks not to mark these assets to market, because they claim that they're holding them to maturity. But understand that there are widespread capital impairments, particularly if interest rates continue to rise. Again, this is available from your bank. And it is also available from your bank data that relates to the amount of very liquid assets, treasury securities of 90 days duration or less, overnight repo funds, stuff like that, relative to the deposit base, the short-term deposit base. It's important, I think, to bank with a bank that can weather a little storm. Silicon Valley Bank did not have that flexibility. This is a relatively easy thing to do. If you want to be more sophisticated, one of the things that I do is read banks' balance sheets and income statements with particular regard to the bank's provisioning for bad assets, that is, provisioning for loan loss, relative to their experience of loan loss. Very good banks consistently over-provision, among other things, because if they take a provision, they can write the provision off their income. It's a non-cash loss that reduces their tax liability. I know of a bank, and I won't name them for fear of drawing them to the attention of regulators, who have consistently over-reserved by 5 times, which is to say that their loan loss reserves have exceeded their loan loss experience 5-fold for at least 10 years. This is the epitome of a well-capitalized bank. They are understating earnings to beef up their balance sheet and to minimize their tax, as opposed to overstating their earnings to jam their price-earnings ratio to loot their shareholders and depositors.